to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, back from the 70s, AJ Brown. Good morning, AJ.
I am sporting this cool mustache from the 70s. That's right.
It must be because inflation's so high. It's like, oh, I got to get back to those times because
I got to get back to those times when I was a kid. Yeah.
Yeah, I mean, the big news this week is 75 basis points again. Wow, like no one's surprised, but in general, that's fairly surprising that we're still hiking at this rate.
Well, and the Fed made the Fed had their announcement on Wednesday. And in addition to just the announcement, it was one of those 4 times a year they get interviewed and have a longer speech, Jerome Powell. And so, of course, that speech was dissected. And it looks like the target that they mentioned over the summer, something like 4 to 5%, that's off the tables, right? But the speed at which they go from moving forward they're talking, all I could imagine, and I heard this from one of the other pundits out there, but all I can imagine when I was listening to that speech was that emoji, the one that's like this. I don't know. That's kind of the speech we got. But what we do know is that Fed rates are going to keep going higher. They're not going to stop anytime soon, but they may go higher at a slower pace.
And so, looking at the data, right? What is the consensus? Feedback, right? Like, because the news came out recently, the market hasn't really moved one way or another. We're still digesting things. We got employment numbers today. We're still digesting things. We're not at all-time lows, but we're kind of close-ish.
Well, let's first. So a report that hasn't been as popular in the past that's now very popular is called the JOLTS report, the Job Opening and Labor Turnover Survey. And the JOLTS report came out on Tuesday, and it said, well, you can take a look right here. They first of all, they revised the previous numbers for August, saying that instead of the job openings being at about 10 million, they're at 10 and a quarter million or more. And then they were expecting for September a reduction in job openings, and instead there's a lot of job openings. Now, it depends on how you're measuring this, because one of the things that's happening in parallel with trying to control inflation is a lot of this government spending, right? We passed in this past year a huge government spending, which is supposed to be giving people jobs in order to create infrastructure, to create, internet down to the rural level, all sorts of like bringing manufacturing back. And manufacturing is coming back to the United States, especially with the fears around China. It's coming back in the last 2 years quite quickly. And so there's all these jobs, and they're like high-end jobs. And that's kind of befuddling people, because typically, if you weren't doing that kind of job creation, you would hope that the labor market would cool at the same time as the demand market in response to the Fed. So a lot of people are looking at this and they're using the old measuring stick, in my opinion, hoping that they'll see something in the labor market based on what the Fed is doing. But at the same time, you've got the Fed controlling monetary policy. The fiscal policy is saying, let's create jobs. So I think that's confusing people, because a lot of the old-time economists, they're trying to see a cooling in the labor market. In fact, today, if I go to today's job reports, there's no cooling in sight, right? This is the job reports for October. It says 261,000 jobs were created. That's about 50,000 jobs more than expected. And they went back to September, SIP, and they revised up the numbers of jobs created in September by over 50,000. People are looking at this unemployment rate and saying, well, that's kind of going up, so that's okay. Remember, these are two different surveys that the government makes. So this survey is not related to this survey. It asks two different questions. One of the things I'm looking at, and I keep emphasizing, and I don't think people are paying attention to it, but manufacturing jobs are coming back in droves to the United States. The United States is picking that ball up after like 20 years of letting it die. The other thing that I wanted to point out is this participation rate. This participation rate, here's what I imagine. Because here's another report, SIP, that I don't think people are paying attention to. Basically, the Fed is making it expensive to do things, right? That's what raising an interest rate does. But man, we like doing things as Americans, as people from the United States. We just like doing stuff. We like spending money, right? And so check this out. A lot of people don't pay attention to this one. Let me come up here. I'm going to change my view here. It's called the savings rate. And check out this trend. So this is January of 2021. In January of 2021, there was about 3.8, almost $3.9 billion in savings. And it even got as high as about $5.7 billion in savings, money that people were stocking away. Now, fast forward, as we go month to month in 2021, that number starts to drop. And now 2022, to the point where the savings right now went from about 5.7 billion to 581 million. So down by a factor of 10. In other words, people are still living high and dry, like really like the way that they like to live, but they're dipping into their savings at a massive route. That, and also like people were investing into some crazy things in 2021, and those things kind of went kaplooey. A lot of our listeners who got kind of wooed by some of these hot investments back then where it was too good to be true, you know what I'm talking about. You lost a lot of your savings. Savings is down to about 1/10 of what it was about 24 months ago. And so, go ahead.
That's a big number. That's a huge number when you look at the grand scheme of things.
And so when you think about these whole things about, supply and the demand, and the Fed can't get the demand, I think they are paying attention to this number, because there's going to be a point, and I have a feeling, mark my words, SIP, in the next 6 weeks, probably like right before to right after the winter holiday season, we're going to start seeing a huge uptick in this participation rate, meaning people are going to be done with their savings. And they're going to be like, oh, I need to go get a job, right? So I think probably next month we'll see it. And for sure in the following month, this number is going to go up. And at the same time, people are going to stop spending on stuff. And so all of these corporations that are hiring, because they're hiring because people want their products right now, I think we're going to see a fall off in demand when people are like, oh my God, I'm down to my final pennies in my savings account, and I'm going to stop spending. And so I think, right now we're right at the peak, and usually before the peak, we have a fall. Right now, if you were to go out this week or next week, you could probably, if you wanted one, you could get maybe the job of your choice. But I think in 6 weeks, the labor market's going to crash. And the problem with crashing the labor market, and I think the Fed has to be very careful about this, and I think they are being very careful about it, is when it starts to crash, it crashes fast, right? And so Jerome Powell keeps talking about, measuring the labor market. The two things he has to keep in mind is, number one, the federal government is creating jobs. So that's kind of a force against what you're measuring. And number two, if you start to see that crash, it's going to go fast. So something to think about, because that savings rate is dropping, and at some point here, people are going to have a reckoning. They're going to stop buying. They're going to start looking for a job, and this is going to very quickly flip from this great employment situation to a really crappy employment situation.
Yeah, and a lot of that logic makes sense, especially going into following the holidays, because you can assume that a lot of people are going to be dipping into those savings in the next month, and it's winter, at least in the majority of the United States. So, from this news that came out this week, what's the market doing? Are we
Well,
falling off a cliff? Because it sounds like all bad news there.
so as of right now, the market is taking it started off today taking the news very positively. And I'm not sure why, except for that, the first hour of trading is amateur hour, and amateurs were probably looking at like maybe this number, or maybe the fact that employment numbers are good despite the Fed tightening. And so they feel that's a positive sign. But I think, give the market the weekend to kind of digest the news. We'll even see it today. I already are forming. We might see the market kind of realize that maybe this isn't a good situation when they delve a little deeper. But when we look at our charts, I mean, let's take a look a little bit closer here. I love looking at my retracements. We had our first move of an uptrend between this low of October 12 and this high of October 28. And then we're having this pullback. Now, I love a good pullback because it basically tells you that, hey, we're going to kind of reload and then we'll go again for another move. And I love it when the pullback goes into this halfway mark. And so this is this halfway mark that I just outlined in blue. This is good so far, but it also depends on what folks think about this number over the weekend, right? So far, it kind of popped up, but I'm going to watch this carefully into next week to see if we don't have kind of like a deja vu moment and start to sell off. So let's watch this very carefully. If it does go up, great. We're looking for 1, 2, 3 moves to confirm our uptrend. If it does what I'm going to be looking out for it to do and really kind of hits the ground here, then all bets are off. I think people are having kind of a realization.
All right. And is that part of the reason that we're seeing an uptick in the defensive names?
Yeah. A couple of things are going on. So I can't not pay attention to the bond selling that the Fed is doing. Bond selling really affects us investors, right? The interest rate affects everybody because it makes money expensive to use. But the bond selling is a way that the Fed is kind of taking away the money that it printed over the last couple of years, and it's taking it away through the markets. And so it's making bonds. I mean, oh my gosh, the inflation bond, you could go and put your money into an inflation bond and you're earning more than the S&P 500 makes on average every year, 6.89%. Or put your money right into these things were paying zero. In fact, they just recalibrated this savings bond. The last payout on this bond was over 9%. These are bonds. These are things that haven't been making money since about 2005. And all of a sudden, in a matter of 6 months, these things are making money. And it has a lot to do with, if we zoom in on the last 6 months of the Fed's been selling their bonds, making bonds have a much higher yield. And what that's doing is it's making people take their money out of more riskier investments like stocks or anything else that's higher on the risk. And they're like, I'll just put my money here. And same thing with moving from tech stocks. We are seeing tech stocks, and we're seeing even real estate kind of hit that bubble and fall, and money is going into these bonds or into more secure stocks. I mean, some of the stocks that we've been looking at as, long-time holders, they would be things like Hershey, right? Because in good times, people like chocolate, and in bad times, they like chocolate, right? Hershey is a good one. Another one is InBev, ticker BUD. This is like the overall, big beer producer. It's Anheuser-Busch, it's Budweiser, and they've also got a whole bunch of non-alcoholic beverages. In good times, people like to drink beer, and in bad times, they drink beer too, right? What else? There's
And it's football season. I'll throw that out there.
Football season. People are like, give me that Kurz, right? Of course, that's a whole nother company. Then there's TWNK, that's Hostess, right? Look at these stocks. These people are going to eat their tasty cakes. They're going to eat their Twinkies. They're going to eat their ho-hos, right? So if you're looking for medium to long-term plays, I'm trying to think of some of the other ones that I might be thinking of. How about PepsiCo? People drink their Pepsi. And another one is the defense market. I mean, man, right now, especially with worries about Xi Jinping getting another, getting a lifetime call to being prime minister of China. Lockheed Martin, LMT. So LMT, TWNK, PEP, HSY, BUD, right? These are companies that if I was moving my money from, like, for instance, more risky stocks into less risky stocks, these are the ones I've been buying. And the way that I am doing that, I'm moving some of my assets, my long-term assets. I'm doing those naked put sales where I can lock in the price I want to pay for these things. And so that's been my recommendation for people who are in the long term, looking to kind of change their long-term portfolio.
Yeah, and if you want to learn more about, what AJ's doing specifically, his approaches, his strategies, I just posted a link to AJ's free daily webinar where you're going to get a breakdown of all of these things. And the word on the street is that you're getting a lot of positive feedback. You're getting a lot of new people coming in and joining you. And if you haven't checked it out, I'd highly recommend you go in there, set aside some time this weekend. AJ, what are you hearing on your end?
Yeah, I mean, my Facebook, what is it called? Messenger chat is just on fire with the number of people who are watching this and having questions about it. And ultimately, they're joining our program, SIP. They're getting into selling premium with us. They're getting into doing some of these other trades. One of the other trades that I've been talking to my program participants about is how to hedge, using the VIX. And so, if you guys want to get inside scoop on that, check out my program, check out that free webinar. There's a lot of content in there. Make sure you bring a notepad, but also consider joining us because we got you covered,
Yeah, and we've got more to come in the show that'll give you a glimpse of what that kind of looks like. If you're watching or listening for the first time, feel free to throw a ticker in there that you're curious about, and we'll see if we can go over it. Otherwise, we're going to take a quick break, and we'll be back with AJ's pick of the week, and then we'll do our speed round, and then if we get any other questions. So sit tight, folks. We'll be right back.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, we're going to need to come up for this new segment name here. Right now, we're just calling it new segment. But the question is, are stock buybacks are back, and are they okay? Is there a specific example that's been in the news recently that we could play on with this?
Yeah, ticker PPG. Let's take a look at that. So this is PPG Industries. These guys, I I believe that they're in paints. You could correct me on that, but they're in paints. Paints for your house. House paints and stuff.
Yep,
And
corrected.
they are
Booster coatings.
yeah. And so they're kind of the big name in the chemical industry behind making sure those like Sherwin-Williams and all those different companies have products to sell us to paint our homes. And somebody did an analysis on them and saw that the raw costs going into PPG um, uh, increased, but not by the same amount that the price increased. And the CEO was caught, saying, hey, if you don't like the price, don't buy our products, right? And then PPG has been doing some stock buybacks. And so the question this week is, are stock buybacks okay? So what a stock buyback, just so people know, is if a company buys back their stock, they're going to wind up raising the stock price. They decrease the dilution of that stock out in the public. And so in effect, they raise the price of the stock. It's not because their company is doing any better. It's not because they're getting new revenue of sales or all. They're just playing kind of a money game with the stock share. And so the question is that a good use of the extra profits that these companies are making? Or should, there's actually talk that might be taxed or penalized, by the referees. In other words, the government. Should that go down? What do you think, Sib?
Isn't the whole idea of free market enterprise, the share market, the concept of, investing in a company and then doing the things that you need to do to increase the share price? And so anybody can get involved in this. So I don't understand how it can be a negative. That's the way that we've built our business, our systems in America. And so I don't see how you can even tax something like that.
Yeah, I mean, you could basically say because when they do a stock buyback, they have to report it, right? And you can definitely detect when a company buys its own stock back, so they can somehow but the next thing you're going to know that dividends are in trouble. These are all ways that a company can pay back its shareholder, whether you take the shareholder's asset and make it more valuable, or whether you give them a dividend, actually give them a check for owning the stock and investing in the company. So again, I'm not sure if it's that bad of an idea, but in theory, you would want the company to actually do better in order to pay off the investor instead of doing some of these accounting games. I guess the argument is you're taking money from the consumer of the products and you're paying back the investor. So it's kind of, moving money from the people who support you by buying your products to the people who support you by investing in your company. And is that, I don't know the answer to it either, but I know that it is a very complex, question.
Well, there's only a few places the money can go. The profits could either sit in the bank or they could be reinvested in the company into expansion, R&D and stuff, or buybacks. Like there's really nothing else that you can do with the money, right?
That's true. That's true. And so I guess the powers that be would like these companies to invest in themselves rather than play around with their stock price.
Well, fortunately for us, as options traders here in the free market enterprise system of America, we have the ability to ride the coattails of the companies that are doing well and the companies that are dropping. And so that's what we're going to do. And then in the rest of the show is we're going to pull up some tickers and we're going to go through some opportunities to, I think last week in our NEO example, that was like a 40% winner. So,
yeah.
Good opportunities that come up in these segments. And so let's jump right into it. And the first ticker, which is your pick of the week, is Warner Brothers Discovery, which I'm not sure if a lot of people know that Discovery purchased basically everything that's Warner Brothers, and they're a combined entity now. And like HBO Max, like they own a lot of titles that we all love. But looking at the chart, it sounds like they're not doing too well.
The reason why I wanted to feature Warner Brothers Discovery is because of earnings. And earnings were reported after market close yesterday. And so you can see right here, the earnings looks like they estimated that they would come ahead about a little under 2 cents a share, and instead they wound up losing 95 cents a share as a company. But I wanted to feature this one because last week I talked about a strategy of profiting off of an earnings play if you have an idea of the direction things are going, and I had an idea of the direction going down. You can profit off of this natural tendency. This is what happens as earnings approaches. People get kind of afraid, and they get afraid. And the way that we can measure this is by looking at how many insurance policies they purchase on their stock. And those insurance policies are options, right? And so if we measure the price of the options as we get closer to earnings, we see this increase in the price of options due to the fact that people are buying these things up in order to protect in case something goes wrong, right? And then right after earnings is released, we see this huge sell-off of the insurance policies, these options, because we don't need them anymore. And I'd like to feature that by showing you. So if I come over here and I take a look, for instance, at a particular option, and I'm going to look at an option on the weekly schedule. So I'm going to come over here and look at the weekly options. And I'm also going to look at some historical Warner Brothers data. So WBD, right? So earnings was yesterday evening. And so let's take a look at this option, weekly option. I'm going to go about 2 weeks out. This is exactly what I said to do. So about November 11th. And I want you guys to pay attention to this number that is right here, this implied volatility number. So you'll notice, like right around here, these numbers are around 108, 104, 108%, right? Now, if I come on back to what it is currently, these are the same November 11th options. Notice it's dropped to 61%. That shows us that those options were much more expensive yesterday, and then after the market close, they dropped today because people don't need them anymore. They know what's happened. The price has changed. And so I created one of those calendar spreads. So a calendar spread specifically focuses on premium. So let's take a look at my calendar spread. So I'm going to go ahead and plot it. So I used a December option, and I used a November 11th weekly option in this calendar spread. So my far out in time option was December, the third Friday in December, and my near term option was November 11th. And I'm going to come here and take a look at this. So I bought these things on November 2nd. And on November 2nd, I paid 35 cents. I paid 35 cents in order to get this. And as of, when I sold it this, because I knew that this morning that these things were going to be, dropping quite quickly, I was able to get 60 cents. And so that's playing exactly what I'm talking about, is this volatility change right before and right after earnings. It doesn't matter what the price is. Now, you'll notice if you guys are paying attention, I used puts. And that's because my long-term belief was that Warner Brothers was going to go down in price, which it did, as you look here. and I was watching it go down in price. If I take a look here, I was watching it kind of go down in price these past couple of days. So when I did this trade, I said I'm going to use puts, but I did a calendar spread so that I would focus specifically on that implied volatility. We call it a rush and then a crush. And so you'll notice that, I bought these things for 35 cents. I sold them this morning for 60 cents, took advantage of that phenomena. And this can be done during all the earnings season. The type of option you choose, whether it's a put or call, that's going to depend on what you believe is going to be going down with respect to the price. And the spread is usually about 3 months out and 2 weeks in. It's a cool trade.
Well, yeah. Well, piggybacking off of this, we got a live question that I think falls into the same industry, and that's Disney, DIS.
Okay.
It looks like they might have kind of fell on those earnings too a little bit.
Let's see. So earnings is going to be on November 8th. That's next week. And it looks like it's going to be after the market close on November 8th. So as we get close to November 8th, so it's Friday right now, November 4th, the market's going to be closed the 5th and the 6th. So on Monday is the 7th, 8th, and then the 9th is right after earnings, right? Because it's going to be the evening after the market closes on the 8th. So either Monday or Tuesday, what you might want to consider is one of these types of calendar spreads. If you think about a calendar spread, what it does is it gets rid of the intrinsic value of the option, because you've got the intrinsic value of the back month option minus the intrinsic value of the front month option. They're at the same strike price, so they cancel each other out. So what you're really dealing with is that change in premium. And so if the back month options premium, that implied volatility number stays pretty stable, and that front month option does, like we saw when we were looking at that option where it goes from like 108% down to 60%, that's what creates your big change. Now you got to be, this is a pretty quick trade. Usually you've got to place your trade, before the market opens, or not before the market opens, a couple days or even the day of, if it's an aftermarket close, or the day before, if it's a before market open earnings. You got to place that trade, and then you want to catch that drop in implied volatility quite quickly on the next trading session. But that might be something you can do with Disney. And again, whether you use puts or calls depends on whether you think that you're going to have a move up or move down.
Yeah. And if you're watching, listening for the first time, and you're not sure what a calendar spread is, but you want to learn, AJ and his team over at Trading Trainer has recently launched, I think within the last few weeks, a special one-on-one program where you can work alongside somebody and learn these strategies, learn how to implement these trades, whether a market is going up, sideways, down, as we're seeing down. And so I'm going to throw the link for anyone that's interested in learning more about this, getting a free, no obligation consultation with somebody just to learn about what it might take to implement these strategies and to just expand your ability to invest in an ever-flowing, complex market. But working with somebody is going to help you understand it so that you're spitting this lingo like AJ's, doing. I'm sure you sleep and you think options. Am I wrong?
Yeah, I see them floating in the air in front of me.
All right, so we're going to go ahead and throw the link to that special coaching in the chat. Head on over there and check it out. Otherwise, we do have one more ticker that we can run by, and then we can go over through our speed round. And we're going to go ahead and throw some music into the background as we do these, because you're going to run through them fairly quickly. But if you want to tag along, that's why we want you to join the program. So the links are in there. The first ticker is CCL. I believe this is one that we've covered in the past, maybe.
Yeah. We looked at Norwegian Cruise Line as part of one of my programs. We looked at it last week. And CCL kind of follows the same sort of look at as Norwegian Cruise Line. It makes sense. They're kind of in the same sector. In fact, if you ever take one of those cruises, you'll notice that the boats sail, right next to each other as they go on their trips. So interestingly enough, they had kind of their drop here. It depends on if you want to have Carnival Cruise Lines in your portfolio for the long term. If it's one of those stocks, this might be a great opportunity for you to pick up some shares and have that company in your portfolio for the long term. As far as short term, it's a very speculative underlying symbol, and it's not in that beautiful sideways channel. It looks like it dipped down. I'm not sure if support has become resistance. It needs to mature into a pattern if I'm going to look to create an income trade out of it. So for me, I'd take CCL and I'd just watch it. Like I'd watch it maybe once a week to see what the pattern, and then once it matures, I'd think about putting together a plan on it.
Okay, we got another question that I think we talked about maybe 2 episodes ago, and that is how to get into a silver or a mining company or an ETF. That was one that we covered.
SLV. That's an ETF, and SLV is really nice for creating income off of it, because you'll notice that it is in this sideways choppy pattern. And, all you have to do is create a differential between the side that you create your initial position on and where you roll out your protective options, and where you're actually setting up your trade zone, where you're buying your protective options and offsetting their cost by selling some premium. And so silver is now kind of coming up and testing this level of resistance up here at 19.25. So this is where you would consider either shorting some SLV ETF if you're not already in the position, or you could buy some back month put options. I'd go far out in time, more than 8 months with these put options, and I'd go deep in the money so that they're kind of a very stable option. And then, you can just wait for your opportunity to sell put premium, buy protective calls. All is good with the SLV. I love this one.
Also, Brian, feel free to check out the YouTube channel. We do have a video previous to this on this example, so that might give you some insight. But SLV is a great metals name to keep an eye on. All right, moving on to some of the other names. This one is coming from Matt in Cedar Rapids, Iowa. He is interested in the company Shopify, ticker symbol SHOP. And his question is, I bought Shop 4th November 22, 20 Jan 23, 35 call calendar debit spread for $1.89. Now what?
Okay, so Matt is doing the same strategy that I just got through talking about on Warner Brothers Discovery. And so he did this spread right here. And let's take a look at the intraday chart. So, so it looks like he bought it. I hate to go to screw you up here, but I'm going to go back to the underlying symbol. So sure enough, if we look at the underlying symbol, let's go to a 3-month chart. Check this out. Okay, so they just had earnings. This was after market close yesterday. All right, I like that. Oh no, that's Warner Brothers. I apologize. We're looking at Shopify, SHOP.
Yes, SHOP.
All right. So yeah, okay. So Shopify had their earnings. Okay, so I see why Matt used calls, right? Matt came into this thinking that this position was going to continue to go higher, and it did. So it did earnings, and these earnings were before market. So what he would want to do would be to buy his calendar spread here and then sell it back on that day, or it looks like he's still holding it. So let's take a look now at the value of his calendar spread.
He bought it for $189.
189. So it looks like maybe that was on maybe 2 days before the earnings release, right around here. That's cool. So look what happened. Exactly, even better than, I wish Matt was my guidance, even better than Warner Brothers Disney. On Shopify, if he paid 189, it jumped up right afterwards to $2.80, and it's going and going and going. Now, your front month option expires today, Matt. And so you really don't want to let that thing get exercised. It's going to get exercised because it's above the strike price. You don't want to get that exercise because that's going to wind up, screwing with your back month option. So you've got 3 choices here. The first choice is just get rid of the whole calendar spread. I mean, you bought it for $1.89. It's currently going for $3.45. It had a high around $4, even as high as $4.20. That's a pretty great return. So you could just liquidate that calendar spread today and be off to the races. I like that idea. The next thing you could do is you could just get rid of that front month option. And if you get rid of that front month option, now you're just long a call option. And the reason why you would do that is if you believe that Shopify is going to keep going higher. If you think Shopify is going to keep going higher in price, being long that call option is not a bad idea. So that's your second choice. The third choice is if you get rid of this front month option, the one that's going to expire today, just go ahead and buy to close it. I'm sure it's worth maybe about a nickel right now. If you pay a nickel for it, you'll be able to get out of that position. And then let's go with a premium trade. Let's find a front month option that's going to expire, say, in the 3rd Friday of November. I think that's going to be November 18th, if I look at my calendar correctly. So you could create this into a premium trade if you don't think that Shopify is going to go much higher. Maybe sell the 4, if there's a 4.5, sell a strike price that you don't think you're going to go above, and then just create an income trade out of that. Any of those 3 strategies, it all depends on what you think Shopify is going to do next, is going to be a valid strategy. But I want to give you kudos because you took exactly the strategy that we talked about last week and you made it work.
Awesome. Moving on to our next name. I feel like this one used to be a darling. This is Neil from Butte, Montana. And this is Coinbase, ticker symbol COIN, coin.
Crypto. This is the crypto exchange, the big crypto exchange. All right. Well, they reported their earnings. So playing kind of an earnings trade on this is not going to be something that we're going to do. We're going to wait another, 3 months and then do that strategy. So let's see if we can make this into an income trade. Because right now, I haven't quite gotten a signal that a bottom has been found. But once I get my signal that a bottom is found, that might be a place where I could buy Coinbase, whether I buy the stock or I buy a call option. Again, I want to go about 8 months out in time or more, even all the way to January 2024. And I want to go deeper in the money, right? The deeper, the better, as long as there's liquidity. So buy some call options. And then as this thing appreciates, allow my call options to appreciate. And if the call options continue to appreciate, great. We're just going to wait for an opportunity at some sort of high, maybe when it takes a pause or it does a reversal, and get out of those and just take the directional money. But if it stops short, of about, I'd give it maybe $80 to $85. If it stops short of $80 to $85, then maybe what I'd like to do is sell some near-term call premium, buy some protection, maybe down here at the 60, and allow that to become an income trade. So Coinbase, I think you're onto something. If you want to get into this one, again, the timing, wait for the good signal. Don't pull the trigger until you see the whites of their eyes. If you don't know what I'm talking about, try paper trading it. See the results of paper trading this. But I think you might be onto something.
Yeah, and looking at the chart, I feel like they're weathering this rate increase fairly reasonably, right? Because they are steep hikes. So maybe crypto's not falling off the cliff like everyone was going to be assuming.
I think it fell off. I think I think there was a shakedown. So there's always going to be the diehard crypto folks, right? And there's also going to be folks who put money in and they're not going to take it out until it recovers. So there's what you had to get rid of is all these looky-loos, right? These people who were kind of thinking that it was too good to be true, and now they've taken the hits on the head. That's probably what we saw here in the reduction of Coinbase. But now I mean, looking at the prices of Bitcoin and Ethereum and stuff, it looks like we've had some stability. So, I have to say that the Fed making bonds so worthwhile are really going to try to entice as many people out of crypto as possible. But as for right now, it does look like crypto has stabilized. You're right.
All right, moving on to our next name. This is Zayed from Paradise, Nevada, and he's interested in Marathon Digital Holdings, MARA.
This is another, I think this is another crypto play, but I believe that versus the exchange, I believe that Marathon Digital Holdings, and I don't know if you've got a pull up on your screen, Sip.
Yes, they're a mining company. They mine crypto.
Yes, and they're in Nevada, and I think that they've got different server farms, and they're actually mining these things, which, that's a trick in its own. I'll
tell you this interesting fact from my research. They have 9 employees.
Oh, that's awesome. They have 9 employees, but they have a ton of equipment, and they're probably that's awesome, by the way. With that said, I see the same thing happening to Marathon that happened to Coinbase. So I think it's being treated all kind of the same way. But look, it's also found a floor. And so let's see if we could trade this thing. And one of the things that we're going to have to check, it being kind of a smaller company, let's see if the options they do. It's optionable, and not only is it optionable, but it's a fairly healthy options market. And I do that by looking at the bid-ask spread. The bid-ask spread really tells us if the market makers out there, market makers are those folks that create the liquidity in the markets. If those guys think that there's some healthy trading going on, the bid-ask spread will get smaller. If there's unhealthy trading, mean there's few buyers and few sellers just sitting in a big empty room like wallflowers, you'll see this bid-ask spread be pretty large. This is a small bid-ask spread. We see some nice open interest numbers. So there is an options market on this 9-person company. And for now, it looks like we've got support around $11, maybe resistance around $14. We just got through. I haven't gotten a signal, just like on Coinbase. I haven't gotten my signal yet that we've hit our lows. But when I do get that signal, man, either buy the stock or buy a substitute call option. I'm going to say it again. Go far out in time, go deep in the money, and then allow that thing to appreciate. If it turns tail, maybe below $15, $16 at the max, then set up an income trade. Sell some premium and buy yourself some protection. The protection strike price will be down here at $11 or $10. And then just let this thing, let the option strategy totally adjust itself. Last week, I got to just point this out. Last week, we featured NEO, and NEO totally worked against us. But the option strategy that we teach automatically adjusts. So even though the underlying symbol has been crashing like crazy, we wound up pulling 40% out of the trade. So when you use options to create certainty, it doesn't matter that the underlying symbol goes in the direction you didn't expect. All of a sudden, these positions auto adjust, and we wind up pulling out money anyway, whether the stock goes up, down, or sideways. So This is a skill that you're going to need in this volatile market. And so if you haven't picked it up, check out that webinar. Come join our program just for 6 months. See if you follow along with our trades. These strategies are going to save your tuchuses.
Yeah, and two more other interesting stats on Marathon Oil. Quarterly sales 189 million, interesting, and on the target analysts, the low is 8, the high is 35. So I think that that hold covered call strategy for $10 stock, that's a good trade for someone that likes crypto to get in the long run if they haven't really done a lot of option stuff.
Now, you said Marathon Oil. Did you mean Marathon Oil, this Marathon Digital
no,
holding? Because
Marathon
Marathon Oil
Digital
is also another company, but I don't think that's what we're.
You're right. I just misspoke. Yeah.
Oh.
Or Marathon Digital Holdings, MARA.
Yeah. So a good way if you don't want to get into crypto, this ticker that Neil from Butte and Ziad from Paradise, these guys are basically getting involved in the crypto market but staying in the stock market. I like that.
All right, awesome. So we've got one last question, and this is one that I feel like a lot of people, a lot of new investors tend to ask, and that is, how often do you or I or anyone needs to trade in order to be successful?
Oh, man. Well, that's going to depend on the trading strategies that you become kind of an expert at, honestly. I personally don't like to trade often. I'm of the mindset, I'm of the philosophy that you should, do these rifle shots rather than these shotgun approaches, right? I like to plan things out very thoroughly. And then I like to follow that plan, and built into that plan, I like to put in all my risk management. So all to say is, per position, if I'm doing an income trade, I'm not going to trade more than about 2 times a month per position, right? So I am by no means a day trader. In fact, if you could call me an end of day trader, that's even pushing it. So I'm trading about twice per month, and I'm creating double-digit returns on a monthly basis for my portfolio, right? But again, it all depends on your strategy, and I think you could reverse engineer that question. For those of you, instead of being like excited about whatever marketing some of these different people who can teach you these strategies, they always have a lot of marketing because they want to sell you the education. Instead, look at your lifestyle and ask yourself the question, what does my lifestyle afford me as far as being an active investor? And that'll point you to the strategy that you want to learn. And then you could be a little bit better of a savvy customer and look for somebody really good who's not only doing what you want them to do, what you want them to teach you, but they also have the ability to teach. And so that's what I would recommend. I would recommend that, number one, that might not be the right question to ask, because some people are very successful and they're day traders. Other people are very successful and they're not often. But what is your personal life allowing? What's the what can you afford to do with your time? And then reverse engineer that question and find out what strategies work best for you. The strategies we do, we have fun, like we've been talking about today, with these earnings plays around earnings. And so these are somewhat fast trades. I trade like right before and then the day after earnings. And that's kind of the fastest trades I do, maybe some breakouts. But most of the trades I do are these premium trades, and I'm trading 2 times per month at the most. So maybe that's appealing to you. Maybe you'd rather be the day trader. Find out for yourself and then go look for the education and your educator to help you with that.
I think what's important is just to be active, right? Because markets go up, markets go down, and there's opportunities if you just know where to look, if you know how to play the right positions. And The beautiful part about options is that it's not really so much a day trading market as you're like putting your orders in and you're being very strategic and a lot of the math behind it. So you're kind of just letting it do the work for you, and then you're babysitting.
Yeah, that's it. And not only that, options create, a lot of people associate options with risk because some options have increased leverage, but they miss the nuance. The reason why options were created 40 something years ago, and standardized, I should say, 40 something years ago, is because options can create certainty. And so that's how I teach, right? I teach how to use options to create certainty, like that automatic adjusting trading strategy that we used on NEO. NEO went against us and we walked away with 40%. And that's because the options created certainty for us. We knew exactly what was going to happen, and it did. And it did it all automatically. We didn't have to be there. We didn't miss any trading strategy, trading signals. It just did it naturally. And when we came back, we're like, oh my God, we're up 40%, even though the stock has tanked. So, take a moment and learn these things, and then you can set your portfolio kind of on cruise control.
Yeah. And if you want to learn, we've got the webinar link in the chat. We've got the one-on-one link in the chat. You can hit that follow, hit that like, hit that subscribe button. Tune into the show. We'll be back every Friday breaking down some of these strategies, providing some opportunities. And if you can hang along, great. If you want to learn, even better. We've got the community. So hit that like, hit that follow, hit that subscribe button. AJ, going into the weekend, going into next week, any final words, anything we should be keeping an eye on?
Let's watch as the broad market digests these employment numbers. We've got another Fed meeting coming up in the beginning of December. People are now pointing at probably a 0.5 point to a 3/4 point rate hike in additional there. And let's also pay attention to this bond selling. I can't emphasize that enough, but the Fed has already sold off about $250 billion. They want to sell off $4.5 trillion. And so they're going to keep making those bonds worth a lot of money. And just so long as you know what's happening in the world, you can trade it appropriately.
All right. Well, thank you for your time, AJ. Thank you, everybody, for tuning in. We appreciate it. We'll catch you guys next week. Thank you, guys.
Bye, everybody.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh